Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Fund Development Analyst. We are here to welcome today Sébastien Réaume, Managing Director and one of the founding partners at AlphaFixe, here to talk to us about their new SSQ Bond and Bank Loan Fund and the benefits of having such a fund in today's economic environment. Please note that if there is enough time at the end, it'll be our pleasure to answer one or two questions via the Q&A section of the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Sébastien, the floor is yours.
Thank you, Matthew. And thank you, everybody, for taking the time. I'm very excited to present this product. It's actually a product that a strategy that we launched in 2015, and we think it's very appropriate given where we are in the current interest rate cycle as well as the credit cycle. Presentation is actually 4 parts. First part is a very quick overview of the firm, then we'll get into the actual product, and then we have a small section on bank loans, which we'll touch on because bank loans is an integral part of the strategy. So if we turn to slide 3, I guess the first question is, who is AlphaFixe? AlphaFixe is a group of professionals that has been working together now for probably close to 20 years under different environments. In the last 10 years together as a group at AlphaFixe. So we are celebrating our 10th year anniversary this year. And when we started the firm in 2008, right in the middle of the crisis, we started our firm with a very narrow focus. And our objective was to become a leader in fixed income. So there's 2 things that are important. Fixed income means that we only manage fixed income here. So 100% of our resources are allocated to fixed income. And we wanted to be a leader. And the way we define leadership is really twofold. First of all, is performance. Obviously, as a manager, we have to perform well, which is something that we've achieved in the last 10 years. And also, the other element of leadership is innovation. So we have to adapt to the environment that we're investing in, and we have to sit down with clients, understand their needs, and tailor approaches to meet the specific needs. And we think this product is actually, the timing of this product is very interesting, again, given where we are in the interest rate cycle. And this is a product that we've put a lot of thought into building characteristics that we think are essential to make it through the next 2, 3, or 5 years in terms of environment, which is going to be very different than what we've witnessed in the last 10 years. Just really fast, if you turn to slide 4, get a snapshot of who the team is. You'll see here a very seasoned team, so a very experienced team. Myself and Stéphane, the 2 founders at AlphaFixe. Diane Favreau is also a big piece of this firm. She joined us from la Caisse de dépôt, where she used to manage bank loans. So when we hired her, she brought her team here to manage bank loans in AlphaFixe. So Diane is also a veteran, I guess, in terms of experience in bank loans. And so you see we're a little bit less than 20 people, 100% dedicated to fixed income. And again, like I said, we've worked together for more than 20 years under different groups, so AlphaFixe, Caisse de dépôt, and then the capital being the 2 main ones. If you turn to slide 5, again, really fast, a snapshot of our growth. Again, we started the blank page in 2008, in the middle of the crisis. We've grown assets quite significantly since then. We're a little bit more than 5 billion of AUM. Important dates relating to this specific product. Again, June 2013, you see we launched our bank loan strategy. Again, that's when Diane joined us from la Caisse de dépôt to manage that at AlphaFixe. And then March 2015, which is the AlphaFixe Return Plus strategy, is exactly the strategy that we're talking about today. So it is a strategy that we've been managing now for 3 years, and again, very, very appropriate given where we are in the interest rate cycle. If we turn now to slide 6, just a quick snapshot also in terms of ESG, so environment, social governance. We were a very early adopter of all the ESG factors. They're fully integrated into the way we look at credit, and a few other milestones. So fossil fuel free since July 2016. We launched a green bond fund in November 2017. Again, another innovation that I was talking about. And in June of this year, we will be calculating the carbon footprint of all our portfolios versus the index. Again, that's something that the clients have asked us to look into. So in a very, very fast fashion, that was AlphaFixe. So if we if we get into the core of the presentation, and if we just move to slide number 8 right away. And in slide 8, what slide 8 shows you is a 10-year Canada yield over the last 40 years. And there's two things I think that are important here to notice. First is the downward trend, right? So we've been in a bull market for fixed income for close to 40 years now. And the question is, you know, do we think that we've hit the lows in terms of rates? And our opinion is that the structural factors, the demographic factors that have brought us to such low rates are actually starting to turn. So we do think that we did hit lows in terms of rates, and we think that the environment for the next cycle is actually going to be rising rates. And they're not going to go a straight line up. I mean, today is a very good example of with everything that's going on in the world. You see that there's a flight to quality, so the rates are actually coming down. But we do think the trend will be higher. So you will see up and downs, but the trend will be higher. And again, that's an environment that we've only seen it 3 times in the last 40 years, which is a rising interest rate environment, which is basically the circles that we've put there. So 94, 98, and 2013 are 3 periods which we've seen rising rates. And if you turn to the next slide, slide 9, so what happens when you're in a rising interest rate environment? Well, the asset class, fixed income, tends to underperform. And again, as we have to explain to our clients the returns of the asset class, just as I presume you do also, and clients really struggle to understand, wait a minute, how come I have a negative return in my fixed income? Fixed income is supposed to be my most secure asset class. How come I'm having a negative return in this asset class? And again, for the 3 years that we have negative returns coincide with the 3 years where we had rising rates. So our argument is to say that going to the next cycle, rates will tend to rise, and as a result of that, the returns in the fixed income space will be challenged to produce decent returns, and even positive returns in certain years, depending on how fast the rates actually do rise. So when we structured this product, it was clear for us that if we wanted a product that would be successful going into the next cycle, we had to take out the duration risk the most that we could, and I'll get into exactly what I mean by that, to try and minimize the instances in which we could have a negative return in this fund. Again, you know, fixed asset being the safe asset class, clients, they struggle to understand why they had negative returns, so we need to build a product that's going to be able to make it through time by minimizing the chances of having negative returns. And if you move to slide 10, so why is it that we could experience negative returns in the next cycle? It's really a function of the relationship between how much yield am I earning in fixed income versus the duration that I have in the portfolio. And duration is the sensitivity to movement in rates. So the longer the duration, the more sensitive my investment is going to be in fixed income, and the lower the duration, the lower the sensitivity. So if we go back to 1995, so you see the green line there. Back in 1995, we had yields in excess of 9%, so very generous yield. And we had a duration which was a little bit under 5 years. So what that does, it protects you as an investor. So we calculated what we call the break-even. So the break-even is by how much do rates have to go up for me to have a 0% return. So back in 1995, we had a break-even of 2%. So if my rates went from 9 to 11, in my asset class, I would have a 0 return. So if they went from 9 to 12, then I would have a negative return. So that break-even was very generous. It provided us a good cushion for rising rates. And if you fast forward to where we are today, so now we're in 2018, where the relationship actually switched over, right? So the duration has gone up, and that's a factor of the fact that rates are lower, and then the issuers tend to issue longer term. So the duration has gone up. Again, duration being a sensitivity to movement in rates. So I have more sensitivity now in terms of exposure to rising rates, which is not necessarily what I want to do, given that rates are so low. And then the green line, you see, it's not rocket science, you see what's happened to rates. Rates have gone down tremendously. So that famous break-even that we call, that used to be 2%, is today 30 basis points, so 0.3%. So again, what that means is if rates go up by 0.3%, I'm going to have a 0 return in my fixed income asset class. And if they go up by more than 0.3%, I'm going to have a negative return in my asset class. So what we're trying to do is, again, understand that relationship. Again, if we go to slide 11, which is a bit more graphical here, the relationship between rates and the effect on price. So just make sure we're all on the same page. So the fixed income has an inverse relationship to rates. So if rates go up, prices will come down. And the sensitivity to the movement in rates, or how much the price is going to move, is a function of the duration, as I explained before. So the longer the duration, the more price sensitivity I'm going to have. And the previous graph I just showed on page 11, that's the typical, what we call DEX universe mandate, has a duration of 7.5 years. That's traditionally what people will buy into when they buy into a product in fixed income. So when we set out to launch the strategy, for us it was very clear that we had to reduce the duration of this portfolio. And by reducing the duration of the portfolio, what we're trying to achieve, again, is minimize the chance of having a negative return in this asset class in a rising interest rate environment. Again, now we'll move to slide 12, and I apologize in advance. There's a lot of numbers in the slide, but it's meant to explain, or at least try to explain, what happens to the total return of a bond given rising interest rate environments and the sensitivity to prices. So we have basically two bonds. We have a 5-year Canada bond and a 10-year Canada bond. The 5-year, when we do this analysis, yielded 0.85%. The 10-year yielded 1.5%. Now the 10-year, because it has a longer maturity, it has a longer duration. So the duration of the 10-year bond is 8.6 versus the duration of the 5-year, which is 4.7. So the 5-year bond has a shorter duration, so it's less sensitive to rising rates. And the first scenario that we show is what happens to the total return of these two bonds in a scenario where interest rates rise by 1%. So you see what happens if you look at the total return for the 12-month period. So your 10-year bond will have yielded you your 1.5% yield, which is the yield when you bought it, but because it has a duration of 8.6 years and rates have gone up, so your mark-to-market on that bond is going to be negative, so you're going to lose 8.6% on the value of that bond, so your total return is going to be minus 7.1%, whereas your 5-year bond, which yielded a little bit less when you bought it because it has a shorter maturity, but it's a lot less sensitive to rising rates. It has a duration of 7.7 years, so you're going to lose, instead of 8.6%, you're going to lose 4.7%, so your total return is going to still be negative at minus 3.85% versus the 10-year bond of minus 7.1%. So the message here is that in a rising interest rate environment, what you want to do is you want to reduce the duration of your portfolio. So that, again, that was our primary objective here, is we need to reduce the duration of the portfolio. The negative, or the flip side of reducing the duration of your portfolio is scenario 2. So what happens if I reduce the duration of my portfolio and interest rates do not move? Well, what happens is that you will have the return of your 10-year, which would have been 1.5, but because you sold that bond and you bought the 5-year bond at 0.85, you're actually going to end up underperforming your index. So the challenge that we have in fixed income is that, like I said, it's a no-brainer to reduce duration if you're convinced rates are going to rise. The issue is that when are rates going to rise? Are they going to rise this year? Are they going to rise in 18 months, 24 months? That is where we have less certainty. And if you reduce your duration of your portfolio today and you're not right, meaning that rates only start rising in 2 years, well, every year you're going to underperform your index because you've shortened your duration. So only duration as a tool is not ideal when you're trying to balance out those two elements, rising rates versus how much you leave on the table if you reduce your duration. So let's move to slide 13. So strategy 1 on slide 12 is reduction of duration. I've demonstrated that in a rising interest rate environment, you're better off holding shorter duration. Flip side is that if you hold a shorter duration, it yields you less, and if rates only rise 2 years down the road, then you're going to suffer a little bit in terms of performance. So how do you compensate for that? Well, you compensate for that by putting credit in the portfolio. And here, the exercise that we're trying to do, kind of similar to what we did on slide 12, is look at two bonds that have a very similar duration, so very similar sensitivity to rising rates. One of them is a Canada bond, and the other one is a Bell Canada bond. And so a Bell Canada bond is a corporate bond, so because it's a corporate bond, it yields more than the Canada bond. So the incremental yield, so the yield on the Canada bond is 236, which is 391 for the Bell Canada one. So you're being paid more to hold the Bell Canada bond because it has a credit risk that the Canada bond doesn't have. So same stress test, right? So if rates go up by 1%, the total return on my Canada bond is going to be minus 2%, right, versus minus 2.2 on the Bell Canada bond, and that's a reflection of the fact that there is a higher yield to start with. So by combining a reduction in duration with a lot of credit products in the portfolio, in the strategy that we're talking about today, we kind of achieve the best of both worlds, where we're significantly reducing the sensitivity to rising rates without compromising the expected return. So if you turn to slide 14, so now we're getting into what goes into this strategy, and there's, if we look at it from a very high level, there's basically two kinds of assets that go into the strategy. The first one is a bank loan. So I'll get into bank loans in a few slides down, but for all intents and purposes, a bank loan is a floating rate product. What does that mean? It means it is not sensitive to rising rates. Actually, as rates start rising, bank loans will pay you more because it's a variable rate. So it gets reset every 1 or 3 months, depending on whether the LIBOR rates are or the CDOR in Canada. So as rates go up, you actually get paid more. So it's very unique in terms of asset class in that actually benefits from rising rates. So that's the bank loans. We put about a bit more than a third of the strategy in bank loans. And then the other 2/3 of the strategy, well, they will go into more of the traditional provincial municipal bonds, corporate bonds, and we have a little bit of Canada bonds in there just to deal with liquidity. So by combining the bank loans with the more traditional fixed income products, we get a portfolio that looks like, if you turn to slide 15, that looks like exactly what we have here. And what we're doing here is, again, the return plus is a strategy that we've been managing. So it's the same thing as SSQ AlphaFixe bond and bank loan fund. And we're contrasting it to the index. So the typical index, again, that we're benchmarked against is the TSE TMX Universe Index. And I just want to highlight the differences. So if you look at where are the differences, our strategy versus the index, the first one is, you see we have a lot less of provincial bonds and a lot more municipal bonds. Why? Municipal bonds pay more than provincial bonds. So that back to the strategy of increasing the yield of the portfolio to protect against rising rates. So that strategy is in that direction. We're kind of same position in terms of corporate bonds. So portfolio has 27%, which is 28 in the index, so we're a little bit underweight, but for all intents and purposes, we'll say we're at the same level. And then you see we have 4% federal bonds versus 37 in the index. So we're 32%. We have 32% fewer federal bonds, and what we do is we take that 30-ish% and we put it into bank loans. So when you put this all together, what does the portfolio look like? Well, the first two things that are important to understand on this slide. The first is that the duration. So look at the duration of the portfolio. The duration of our portfolio is 3.76 years versus the duration of the Universe Index, which is 7.4 years. So we're 3.65 years shorter than the index. And keep in mind, the primary goal when we structured this product was to reduce the exposure to rising rates. How do we do that? We do that by reducing duration. So that's the first key characteristic of this product. It has close to a little bit more than 50% less exposure to rising rates through duration. So that was our primary objective. The second objective that we had is we wanted to do that. We wanted to reduce duration without necessarily compromising on the yield. Now, bank loans, as I mentioned, are floating rate notes, so they have no sensitivity to rising rates, and they also yield quite significant in terms of let's call it 3.5–4% yield, which is still pretty good in today's context. So by combining all these assets, the yield on our portfolio is 3.36% versus the yield on the index of 2.57%. So we have, let's call it 80 basis points, so 0.8% more yield than the index, even though we have a duration significantly less than the index. So we're able to achieve our both objective, which was reduce the exposure to rising rates without compromising on the yield. And that's what we think this product is actually quite unique in the Canadian space. It's very, very difficult to achieve what we've done, and we've done that, like I said, by combining more municipal bonds, corporate bonds, and bank loans in the portfolio. And what's important to understand is that I'm showing you today where we are, and that's given where we are with the current interest rates. What's really important to understand is that this product is not a static product. It will evolve in time. So if rates actually do start rising, you will see that we're going to increase the duration of the portfolio. So we're going to decrease the deviation, the negative deviation versus the index. So it's a dynamic process. And I just want to take maybe a few seconds on slide 16 to highlight how this product could evolve throughout the cycle. So first on duration, we could see minus 5 years or plus 5 years versus the index. So right now we're at minus 3.7. When rates were a lot lower, we were very close to the minus 5 years. Again, that's something that's dynamic. If rates actually do start rising significantly, we're going to see the duration go up. It's going to eventually be equal to the index of the benchmark. And if rates continue to rise, then we're going to actually increase it more than the duration of the index. So you have an idea of how that could go throughout the cycle. So if we're right that rates are going to start rising, this product is going to evolve in time. And it's not going to be a static product, it's going to evolve in time, and we're going to capitalize on if rates go up too high, then reversing rates back to what we think is more normal rates. And you can see where the other ones are. So bank loans, you can see we go to 0 to 40%, corporate bonds, provincial bonds, municipal bonds, and the federal bonds. So again, just to give you an idea of how we could redeploy, how we could adjust this portfolio if the environment changes, we have all the tools we need to be able to make it through the cycle with this product. Now, on slide 17, probably one of the most important slides in this presentation, yet very simplistic way of looking at a scenario analysis. First thing to notice, this is a static analysis, so it assumes nothing moves in the portfolio. And what we're trying to demonstrate here is what happens to the portfolio or this strategy versus the index in a rising interest rate environment as well as a decreasing interest rate environment. So we'll start with the simple one, the one right in the middle, scenario where nothing happens, so rates stay exactly where they are. What we're looking at here is a cumulative return over a 5-year period. So again, this is year 1, 2, 3, 4, 5, all added together. So the blue line is what the index is going to do. So on a 5-year horizon, cumulatively, if rates don't move, you're going to generate 14.2% cumulative return if you invest in the index. If you invest in the fund that we're suggesting, your return is going to be 18.5. Now, why is it higher? That comes back to there's no movement in rates. The differential is explained by the fact that our portfolio yields more than the index. So every year you get your 80 basis points more. And if you look at it in over a 5-year period, that's what it looks like. Now, the easy scenario to understand is what happens if rates rise. As I mentioned, this product is positioned for rising rates. So if rates go higher, what's going to happen to your return on the index? You see the return actually goes down. And why does it go down? It has a duration of 7.5 years. So if rates go up, your mark-to-market is going to hurt you. You're going to lose on your capital. So your cumulative return goes from 14.2 to 12.9. And you see in the meantime, the return on our portfolio actually goes up. And again, that's a reflection of the fact that bank loans will benefit from rising rates. So the cumulative return goes from 18.5 to 19.1. Same thing, if rates go up, that's a scenario where rates go up by half a point, so 50 basis points. If they go up by 1%, same logic. So if we are right and rates do go up, this product is going to be a star performer in the Canadian market without a doubt. Now, the risk is actually if rates go down, because we reduce the duration, because we're concerned about rising rates. Well, the flip side also happens. If rates do go down and you have less duration, what happens in that scenario? So our insurance, we call it an insurance policy. Our insurance policy is how much more our portfolio yields versus the index. So if we're wrong, and actually rates do go down from this point, our portfolio is still going to do relatively well versus the index because we have that insurance of 80 basis points incremental carry versus the index. So let's go to the extreme scenario where rates go down by a whole percentage point. Again, we'll look at the blue line. So the blue line goes from 14.2 to 16.6. Why did it go up? Again, rates came down. I have an appreciation in capital. I have a duration of 7.5 years, so my cumulative return goes up. And you see the green line goes from 18.5 to 17.1. Why does it go down? Bank loans, if rates go down, will pay a bit less, so the asset class doesn't do that well. But you're still ahead of the game on a 5-year basis. And that's what we really, really like about this product, is that, you know, you really are paid to wait through the next cycle. So if we're right and rates go up, next year or even this year, fantastic, right? But if they only go up in 1, 2, 3 years down the road, you know, you still get your positive carry versus the index, and then you're going to get the appreciation or the incremental added value by the differentiation of duration. And if rates do go down, which is not our scenario, but if rates do go down, your insurance policy is your 80 basis points. And even in that scenario, you're still okay versus the index on a five-year basis if it goes down 1%, and the stress test, if it's half a percentage point or 50 basis points, your break even is 3 years. And that, we think, is a very unique positioning for this portfolio in what we see outside, what we see out there in the Canadian market. So how has this performed? If we go to slide, I'm conscious of time here, I want to make sure I hit all the subjects. Slide 18. So how has this, like I mentioned before, this is a strategy that we've been managing since 2015. Well, you can see year by year, you know, it's a little bit more volatile in terms of value add, but it's certainly a product that's done well in 2016, 2017, and obviously in 2018 we're starting to see higher rates. So I'll just maybe focus on the 2018, the year to date there. You see the universe has produced a negative return, again, because rates have gone up, so minus 0.76 for the universe. And our product has actually stayed positive at 0.25. It's not rocket science. Again, why is that? The big result, or the big driver behind that is the fact that we have a lot less sensitivity to rising rates. So we have a value add of 101 basis points since the beginning of 2018. And as I mentioned before, this portfolio is positioned for rising rates. So obviously, if rates do start rising, it's going to outperform. It's going to be one of the best products in Canada. And again, the flip side is that if rates stay where they are, we still have that protection of the 80 basis points, and even if they go down, that does protect us. So that's the product itself. I'm going to touch on bank loans because it's a significant part of this strategy. So if you turn to slide 20, so what is a bank loan? It's not something that, it's not an asset class that's very well known in Canada. It's actually it's very popular in the U.S. And the best way to explain a bank loan is actually, if you look on slide 20, we show the example here when Burger King bought Tim Hortons. So, you know, round numbers, it was a $27 billion transaction. The sponsors put up the $18.7 billion in equity. So they were still looking for close to $10 billion of capital. So they go to the banks and they say, okay, we need $10 billion of capital. Can you lend us the money? So the bank syndicate is going to look at the structure, look at the business, the volatility of the cash flows, and they're going to come up with an optimal capital structure. In this case, the capital structure, so the $10 billion was the incremental $10 billion required to finance this transaction was $2 billion of high yield and $6.8 billion of bank loans. So the first thing that stands out is that bank loans as an asset class is very, very big. They tend to be very big size transactions. And why would the bank lend $6.8 billion when the high yield market is only good for $2 billion? So that's the first question that comes up to mind. And to understand bank loans, if we bring it back to what we could all relate to, is a bank loan is like a mortgage. So tomorrow morning I walk into a financial institution and I say, okay, I would like to buy a house. They're going to look at my credit history and they're going to say, okay, Sebastien, you know, given your credit history, we'll give you a mortgage of $300,000 to buy your house. So the next day, I will walk in the same financial institution, I'll meet the same person, and I'll say, I'd like to have a personal loan. And they're going to say, okay, you know, we'll lend you $10,000 to $20,000. So why are they willing to lend me $300,000 for a mortgage and only $10,000 to $20,000 for a personal loan? Well, it's very easy. The bank knows that if I don't pay my mortgage, they have the asset, so they can seize my house, take possession of my house, sell it, liquidate it, and recover their loan. They can't do that for a personal loan. Personal loan is basically based on my personal credit history. It's the same logic for bank loans. So they tend to be bigger in size, and that's why you see here the difference, 6.8 versus 2.3. And again, the banks will gladly lend you that amount, but only if you, and I'll turn to page 21, only if you basically, as a company, give up all the assets as a guarantee. So bank loans are first lien, which means that if something goes wrong, the banker will step in, take the assets or sell the business, recover whatever's owed to him, and then whatever's left will be split between the high yield and the equity people. So first lien secured, those are two very important characteristics. I already talked about the floating rate notes, right? So these are floating rate note products, so they actually benefit from rising rates. They have a little bit tighter covenants, so we tend to ring fence the cash flows around the company. And as I mentioned before, they do offer a compelling yield given where we are in the interest rate cycle. So bank loans, again, we AlphaFixe, our bank loan fund, will buy from the bank syndicate exactly the same tranche that the bank has on its book. So if we lose a penny, they lose a penny, so we're fully aligned with the banks. And if we just come back to page 20, again, just to make sure we understand the waterfall here, before I lose 1 penny on a bank loan, I have to wipe out 17.8 billion of equity. I have to wipe out 2.3 billion of high yield, and then I start losing money. So for us, bank loan is the optimal position in the capital structure, senior secured, and in credit, when credit gets difficult, the most important element is where are you in the capital structure, and bank loans are exactly where we want to be, senior secured first lien. So that's why we like bank loans, that's why we think it's a compelling value proposition, and that's why we put 35% of bank loans in this strategy. And I think my time is up. So.
All right, thank you, Sebastian. So we'll now proceed to the question part of the webinar. Just a reminder, if you have any questions, you can use the Q&A section on your WebEx interface. So the first question we have, somebody wants to know if he understands correctly, you make the dynamic bond asset allocation throughout the financial cycle?
Yes, it's a very good question. So again, what we're saying today is we're positioned for rising rates. And we have a high conviction that we're going to see that happening over the next 18 to 24 months. So the portfolio, I emphasize that's how the portfolio is positioned right now. It's positioned for rising rates. Let's fast forward, right? So let's fast forward 18 months down the road. So rates are 2 basis points higher. We have, probably closer to recession at that point in time. The portfolio will look very differently than it looks now. So it is a product that will make it through the cycle. Right now it's positioned for rising rates, and if rates do go up and they go up more than what we think is normal, then it's going to be positioned for decreasing rates. So yes, the answer to the question is that this product is a dynamic allocation. It's not a static allocation, and it's going to be a reflection of where we think rates are versus where the equilibrium rate is for rates.
Right. Thank you, Sebastian. So no more questions. Again, thank you for your time. If there's no more questions, this will conclude the presentation. So to all who have listened to the webinar, thank you for your participation, and come back on June 19th as CI Cambridge will present their Canadian Asset Allocation Fund. So thank you, everybody.
Thank you.